Hi, good evening. It's Sunday, January 26th, and we're going to hit it up once again the weekly plan for ES futures. Mainly, we want to look at the market structure, take a look at expected fib levels based on the prior week's range, and take a look at the gamma exposure to see whether or not there's alignment between the imbalances in the market and what we expect for potential places of rotation. So let's go into plan from last week. So if you watched the video from last week, we drew up this plan, pretty much looking at the weekly volume profile, and we identified key areas where the market may move towards and where you may watch for rotation once the market has come back to sweep some liquidity. So in the middle of my chart here, you see the numbers 1, 2, and then above here, BA 6, 7, 8, 9. And the box here was the prior closing range for the Friday. So not this last Friday, but 1 week prior. And what we were really interested to see was whether or not this gap would fill here around 60.10, 60.02 for ES. So that was a little gap up here heading into the Friday session. And the way below there, down here on number 3, this was the low from the Thursday session. And you don't see it on this chart, but there was another gap below for that CPI move on the Wednesday of that week. So what we saw on that opening day on Monday was a bit of volatility. We had the inauguration for President Trump coming in, and then all of a sudden there was a big inducement play that pushed price down to 1 and 2 overnight. And we'll see on the next slide, price came right to the bottom of that box where I marked Loth's key level 2. 5990, 594 was really the rotation area. And then the market basically ripped, going all the way back to 9, and actually just a touch higher to 6150. So what that was an expansion at prior day's range, that Friday, down to the 1.618 or the negative 0.618, and also just coming back to that daily VPOC here, this orange line from Thursday. So we see the residual gap here, or the imbalances from the overnight trading on Thursday came back to sweep, and then there was a big amount of absorption. So I'll show you that on the next slide here, just here. So this is quite messy, has all my notes on it, but you could see a huge gap up and then a huge gap down here. So that filled this balance, and then we see the market climb up. And the way what we identified here on that weekly plan was this level A here, 60.50, as a very key level for the market to continue to go up. And if we looked on our monthly chart, I don't have that here right now, but if we look at what that price corresponds to, well, that's the weekly high, that prior weekly high, but it's also the 1272 expansion of the November range. So maybe I'll pop that open in a slide later on. But basically, once that tested a few times, and you can see there was a double bottom here, right at that level, the market accepted continuation going up, and we effectively swept the rest of the range from January. So if you look at, I'll go that real quick here. If you look at the prior all-time high chart here, the very left here was that gap down, or the sell-off due to that kind of the options day where there was a lot of exposure way below, so the price dropped. That left a massive gap here, all the way to 61.50 right here. All this purple here represents net seller imbalances. And over the period of the last 3 weeks, we've had up and down, leaving this naked area here, or this area that hasn't been closed out or balanced out. So you just go back here a couple of slides, just looking at the volume profiles for each, I believe those are each days. So 6150 was this level right here. You can see there was this inducement up and inducement down. And as soon as we had a retest of that level right here, right in the open for the 21st, then we pushed up to those levels. And now you can see here there's a bit of sorry, the market has been trading in this range between Thursday's VPOC, and now we've had this failed breakout on Friday last week. So what remains here now is potentially the market can come down to rebalance the new gap here that formed between 60.80 up to 60.100. That's beginning of the week's gap here. And then we still have some residual imbalance that came in on the Friday sell-off at the end of the day for options expiration. So we'll dig into that later, but we'll see why price came down here on Friday. We had a huge gamma exposure on puts right here at 61.25 for ES. I believe that's 60.90 on SPX. So price came down here after it broke down on that daily VPOC and came right down here. These are the levels I posted in the video from last week to have taken note. And again, we were really keen on looking at the breakout above 60.50, and that would push up to these two naked VPOCs from the beginning of January 17th, 18th, and that would fill up pretty quickly. So we targeted a push up if we pushed above, then we go 6100 and then 6134, and basically that's it went a little bit past what I thought it would, because what we identified here was this node, this large node here of you could say overbuying on that 18th reversal, and I was not sure it would push up. So we really had to wait for this week to see what would happen. If you look at the macro from last week, not a lot of things on the calendar, except for existing home sales, consumer sentiment data, and the jobless claims late in the week. And initially in the beginning of the week, it was quite bullish. We had the inauguration, and the market didn't have a lot of headwinds to push up higher. And just to say that not a lot of surprises on the home sales. There's still a lot of home sales. So maybe that became a better pressure on the market for inflationary reasons. And also on Thursday, the jobless claims are pretty much at the same level, so not rising too much higher than what the market may need for the inflation to slow down. So if we look at what else happened, last week we started to see a lot of the big earnings reports, or the mega caps, come to report their earnings. The main one that was probably of interest to many people was Netflix. That jumped up 10% overnight, and so that, because it has a big weighting on the indices, that had an impact and pushed prices up on Tuesday overnight. The other ones were GE, Discover Financial, and Charles Schwab also were very positive. So I plotted this chart just to see how big of a beat the reported earnings were relative to the consensus analysts' estimates. So a lot of these big companies had a huge beat, which supported the move, or in some way supported revaluation of those prices. And there weren't a lot of surprises to the downside. So let's look ahead to see where we may expect the market to move. Implied volatility based on the options on SPX is showing potential move of about 70 points for the full week. So that's not very high. Most of the move that's expected is later through the week. So you can see for the next couple of days, here we're at 26, 27. It's not so much of a move that's expected, but gradually we may see a movement down to the end of the week of 70 points. And looking at the deltas here, the gamma exposure for the week, we're kind of pinned right now around the 6100 level for SPX, which is effectively 6125 for ES. And then there are these two towers of gamma exposure at 6150, which is about 6080 ES, and 6050 SPX, which I believe is 6080 on ES. And the macro coming up ahead this week, we have very big week we have a very big week. We have the FOMC week. The interest rate decision shouldn't be much of a surprise. The entire market is not banking on any changes because of uncertainty in the economy for the U.S. Relative to the tariffs coming online, and also there has not a lot of new data showing a slowdown on inflation yet. So that may just not be much of a surprise. But what the market will be very interested to hear is the outlook given by the Fed chair on 2:30 on Wednesday. So that might be a day to stay a bit clear on heavy positions. Unless, of course, that's your strategy. And then on Friday is really where we might have a lot of movement. We have the PC price index coming on play, personal income and spending, and that usually has that usually expands the range quite a bit for the week. So we might see a sweep of the liquidity that's still in the books for the week. And Monday we have ISM manufacturing PMI. To add to that, we have a lot of earnings for next week. A lot of the big Mag 7 report. I don't know if I have that on here. Let me just skip ahead. Yep, so this is the chart I have. You can zoom in on the PDF later. This is from Earnings Whispers. Huge earnings week, particularly on Wednesday and Thursday. We have Meta, ASML, Microsoft, UPS, MasterCard. So those ones will probably move the market quite a bit and may or may not start a trend. If you go back to the macro here, this is the Fed tool to look at the interest rate outlook. There's not much change expected for this month. So most 99.5% odds there'll be no rate hike or cut. What's interesting is, what will be interesting to hear is whether or not they're leaning a bit more for a dovish outlook for the following months. The market is a bit split right now. Some of the market is very much looking at 2 more cuts coming in play in the next couple of months, which might be quite more aggressive than the market could handle. So let's take a look here. This is the implied volatility for the rest of the week. With a lot of exposure, most of the gamma exposure is going to be later in the week, so we may not see a lot of huge moves related to the market moving around for gamma. But on Friday, that's a really important day, so just be careful of big moves on Friday and Monday. So let's take a look now at the VIX here. This was quite interesting last week. The VIX was pinned. This might be the wrong chart, actually. This is from the prior week. Let's go to this one here. Yeah, this is VIX from last week. It was pinned around the 16 level pretty much all week. And that's, I think, partly related to the calls on VIX being very, very high above 16. So we'll look at that chart in a second. But that made for quite a slow and steady advance for the last 3 or 4 days. Not a lot of volatility, not a lot of barcoding and choppiness until Friday, where we had that big correction because of options expiration. And here's the exposure for the VIX. You can see most of the open interest was around 16. So I think that might have had a play in why we had a calm week, or a calmer gradual move. And just to look at the bonds here, we really had the shift and turnaround middle of the week here, where the yields for the US 10 and US 2-year Treasuries came down quite a bit, and that also supported that move up. Partly, I think that spin around here was related to some of those policies from the US president saying that they may not push all those tariffs right away. I don't know if that could just be an excuse for this turnaround. It happened to be a sweep of the monthly range for the yields. So let's kind of jump right now quickly into levels. That's probably what's most interesting for you. This is the footprint on the daily 1D bars. And I've highlighted here on this chart where there are very obvious gaps, very large imbalances that came onto that printed through that rally this week. So we can see around 60.85 to 61.02. There's a big gap here and a naked 1D volume point of control. And then there's another gap between 60.55 and 60.72. So these two probably will be of interest for the next couple of days because there's a lot of volume that printed without the market coming back to reauction that. And just above we have the VPOC from Friday at 60.47-ish. So there is still some net seller delta above here that you may consider the market may come back up to retest. So I would be interested looking at shorts from this level up here. And then on any decline, I would really want to wait for a specific level to enter because a long may be risky anywhere in this range until we come down to the volume port control from Tuesday, or maybe if we come all the way down to the 6,000 level where there's a net imbalance as well right here. So what does that look like on the charts? So this is just the same data really, but on a bar chart. And I put some numbers here for those boxes. Again, this box here is that big gap right here on that naked 1-day volume point of control from the 21st. And then we have up here in the A and the star, the imbalances that came on the Friday reversal. So I think it would be very important to monitor how the market responds here at this orange line or this star right here, 61.45-ish. And down here at this 1D volume point control. So I put two asterisks. This is 60.80. Whether the market goes down further or not will depend on how the market responds here. And also here if there's a big rejection. In both places, if the market sees a lot of buying, then we may see an advance to the 61.80 level for ES. Again, here if we have a large amount of buyers come in, this may propel the price to come back up to sweep the residual shorts from Friday. So it's not necessarily a spot where it could be a spot where you wait to see how the market responds here, either up or down, and same here, up or down. And in the middle of this area, we may see price come down just down to 61.15 right here. That was the net imbalance that remained from the week. That's just in this range in between. There's a lot of buyers that came in on this reversal overnight. So that may be another bounce zone here. Below this area here, so if the market does start to sell off through the week, then we could see price come down all the way to this imbalance from that Monday overnight reversal where there was that big inducement and flip. And that's around the 60.10, 60.05, all the way down to the 59.40, the prior week low. So that's the weekly low from last week. So this area here it's kind of a large gap, very low volume, but the price reversed very quickly, and that was right on that news when President Trump was signing the executive orders for terrorists, executive orders, and he spoke about tariffs, and the price came down and came back up here. So that might be an area to be mindful for revisit through this week. And then down here I have 567. So this would probably necessitate a really big adjustment on the macro lens, either the rhetoric from the FOMC on Tuesday, or else the data from Friday's macro release, or else Monday, where we may see a big adjustment by the market, because there's a lot of volume here between 59.50, 59.90 that may not push down quickly. But that's the gap from the CPI. And if we look at, I'm going to shuffle quickly over to the open interest by strike on SPX. If you look at the data here, there are a lot of calls just at that above those levels here. So a lot of puts at 60.50 SPX. So 60.50 SPX is basically 60.80 ES. And that might be a wall for a while. The price may not decline until this comes off the books through the week. So 60.80, if you go back to that chart here, that's the bottom of this. Going back to that chart, sorry. 60.80 is way up here at number 1. So this orange box here is probably going to be quite a stronghold for a few days, at least for tomorrow. And then we can reevaluate where the gamma exposure is after that. So I don't think we'll come down all the way to here quickly until that changes. So on this chart here, if you're going to use this as a reference to the week, I've just labeled all the key daily volume point controls that haven't been touched and some of the imbalances to keep track of. It really boils down to, for this week, that 6150 level. 6115 will be a test tomorrow. And then the real key one is really that 6080 level. If the market can hold, the buyers want to hold that, they'll hold that very firmly. And then if not, we'll see a weekly trend where we may decline to the lower areas, 50, 60, 64, 68, 60, 16, 60, 02. And then the gap below CPI is down all the way at 58.92, which is quite a massive move. So you might recall that first slide I had earlier, the market implied move was 70 points for this week. So 70 points would just get us down to 60, 60 only really for this week. So I'm looking for a move around that prior weekly high down to 60.50. Below that, we're willing to have a bit of a surprise later in the week. And just for tomorrow, if you're using my Loth level charts, which you can subscribe to and load up these charts, I've labeled all the expected bounces, I guess, or the areas where we may expect reversals and sweeps. So I'm going to be mindful for a sweep here at 60.15, 60.18, the number 2 level here, and potentially the market could come back up to that 61.60 level later in the day through the RTH session. So these are the areas in the beige boxes where you may find a sweep and then a reversal, a sweep and then a reversal. And then in the areas here in orange, these are technical zones where the market tends to reverse based because of deviations and because of fibs. So this one here in A is the 0.382 of the New York Friday session. So we often always see a reversal here, and that may be a wall initially for a little bit. And then way on the outside extremes, I have the green box and the purple box. So these are very high value areas if the price does eventually get to that spot. So if it does come down to green, this is probably definitely a great long for the day. And up here on purple, it's going to be a good short for a very many reasons. We have a large gap that will get filled. We have a large amount of liquidity, which will cause the market to be oversold. So then we see a flip. This is also the 1618 expansion of that daily range. So technically there'll be a lot of algos that will come in to buy that back, to push price back into the mean. And also there is a very high gamma exposure on puts at 60.80. So just above here, the market may protect this area. So I'll be watching for anywhere from 60.80, 60 to 90, and a little bit higher as a very nice long position. And on the opposite side, 61.80, if the market does go back up to there, potentially it would be a short, but I would think we may only get up here after a sweep of this liquidity. If it goes up there and we see large rejection, then it could come way back down here, but I think rejection would come right here around the 61.50 level, 61.45. So that wick from the Friday reversal on the top. So I'm going to go back here real quick just to look at one last thing here.